right. Thanks you guys for joining us today for another presentation with Bay Equity Home Loans. And this time I'm pleased to introduce Kyle Williams. I know Kyle from a 1031 exchange that I did, it's been less than a year ago now, Kyle, that I was working with you guys. And him and his cohort in crime, is it Angelique? Do I have that right? Angelina.
Andrea?
Andrea, well, I'm close. It's been a little while.
Yeah.
Tell Andrea hi. She
Yes.
was great during the whole process. So I got to know them. Kyle has presented at another investor group that we have. So I've seen that as well. And he was kind enough to give us some time today and talk about 1031 exchanges. He's part of what's called IPX 1031 Exchange Group, which works with Chicago Title and Fidelity. Correct, Kyle? Is that right?
Yep, correct.
And I believe you're the vice president of IPX 1031. Is that right?
Yeah, I oversee sales in the state for IPX 1031. And yeah, we are the exchange division under the Fidelity National Financial umbrella. So Fidelity, Chicago, as you mentioned, Tycor. There's actually a bunch of others, Fidelity, Home Warranty. We're a pretty big company.
Good. Well, Kyle, why don't you take it away? I know you have a presentation and we'll go from there. Guys, attendees, if you have any questions, feel free to put them in the chat box, and Marion and I will monitor that as we're going along. And occasionally I may pause Kyle so he can answer a question, but if it goes to the end, we'll also leave time at the end for some questions at that time as well.
All right. Yeah. Thanks, John. Yeah, so my name's Kyle Williams. As I mentioned, I oversee sales in the state for IPX 1031. I've been in the financial industry for almost 20 years. So I've got quite a background in 1031 exchanges. Most important thing today, I always say, call me with questions as you guys have them, but please just jump in and ask questions as you guys have them. It's kind of a smaller, intimate group, and really it's just here. John put this together really just for your knowledge base, for information, to better help you guys learn about 1031s. Tax law is exactly what 1031 is, and tax law is very complicated. During the process, we'll work directly with the client's CPA, attorneys, lenders, brokers, whoever's involved in the transaction, and help them as well. So most important thing to remember today, ask questions as you guys have them. And if you think of anything later, call me with questions as you guys have them. So what is a 1031 exchange? 1031 exchange allows an investor to sell their investment property and use all the equity. That's the key phrase, all the equity, not just the after-tax equity, to reinvest into something bigger and better. You can reposition assets throughout your entire life, and you're always deferring the tax. And if you do things correctly, you can pass up to $11.2 million worth of stuff to your heirs tax-free at the federal level. One thing I always encourage investors to do is have a good CPA. Work with a CPA that understands 1031s, because really they're kind of the unsung heroes in these sort of transactions. Because they're going to help you dot I's, cross T's, figure out what tax liability is. We're a disinterested party in the transaction. So if you call me and say, Kyle, listen, I'm thinking about doing a 1031, but I don't know what I'm going to be deferring in taxes. Help me figure that out. We can't do that. Your CPA would do that. So again, work with a good CPA, lender, broker, all the professionals involved. So 1031 is pretty cool. Really, there's just a couple rules to follow. And I focus on the first two: buy for equal or greater value and reinvest your proceeds. So let's say that you sell for $900,000 and have $600,000 in proceeds. As long as you buy for at least $900,000 and reinvest all $600,000 in proceeds, you'll have a successful exchange. These other rules can get confusing, especially number 3. Because if you look at that rule, replace the value of the debt on the relinquished property with debt on the replacement property of an equal amount, and that's super confusing for everyone, right? So I say, as long as you buy for equal or greater value and don't touch any money, like reinvest your proceeds, everything else just falls into place from a math standpoint. All right, some common motives that we see for 1031. Cash flow. Cash flow can be largely age dependent. Retirees, for example, that don't work anymore, cash flow is super important to them. They may have owned land for 30 or 40 years, have a big gain in it, and they want to exchange it for rentals, something where they can start collecting income from now that they're retired. Reducing management burdens. There's actually ways now where clients can exchange out of investment properties, like say fee simple properties like rentals, and exchange into passive real estate investments. This is kind of a unique thing. That's what I'm going to get off in the weeds with. But again, ways to go 100% passive now with real estate investing in 1031s. Depreciation. So depreciation is like the #1 tax benefit to even owning investment real estate. Depreciation is basically an amount you can write off based upon the value of your investment property over 27.5 years if it's residential, 39 years if it's commercial. But some people have owned property for a number of years, and the property's gone up, maybe doubled in value, for example. What they'll do is they'll sell that investment property and exchange into something that's, say, double the value, and basically double their depreciation, their write-off every year. So this is something where working with a good CPA would really help figure out if that makes sense for you. Appreciation. This is something we see with a lot of younger people, like millennials that buy their first rental, for example. Obviously, everyone wants, regardless of age, income, circumstances, whatever, everyone wants their investment real estate to appreciate, right? But with younger people, this is why they get into the real estate game. This is why they buy investment properties, is for appreciation. They're not concerned about cash flow. I mean, yeah, younger people want it to cash flow enough to cover a loan and all that, but they really want it to appreciate. You might have older people that have owned rentals for 40, 50, 60 years, and when they do an exchange, their main goal is not to see appreciation, right? Largely age dependent. Conversion. There's actually ways where you can exchange out of your investment property and exchange into your eventual dream home. I will get into that in a little bit. And lastly, use in profession. So if any of you are business owners or no business owners, they can actually sell their investment properties, like a rental, for example, and exchange into a commercial space that they own. That way they're paying rent to themselves and they're getting the tax benefit of depreciation. Many business owners that are also investors have no idea that they can do this. All right, if we look at some numbers here. 1031 permits deferral of capital gains. This is the big one that everyone talks about. Capital gains tax at 15 to 20%. If you own a property, an investment property, for any length of time around here, you're probably paying closer to 20%. Depreciation recapture. We call this the hidden tax because most people don't know about it until they've been hit by it. But that big tax write-off you get for depreciating your property, that's taxed at 25%, whether you take it or not. I've talked to more people than I can count over the years that have said, Kyle, we're not worried about depreciation recapture because we never took depreciation because we heard you had to pay it back. You have to pay back depreciation on your investment property, whether you took it or not. And unless you own land, I mean, if you own land and there's nothing to depreciate, you don't have to worry about it. But if it's an improved property, basically anything else, you will have depreciation recapture. So yes, you should always be taking depreciation on your property and working with a CPA that will go over your depreciation schedule. And lastly, we have the net investment income tax, better known as the affordable healthcare tax or the Obamacare tax of 3.8%. So when clients say, oh, Kyle, I think I'm probably I may not even do a 1031. I just have some basic questions because I think I'll probably just pay 10 or 15%. That's essentially impossible. Some back of the napkin math investors will use is 25%. I mean, can be higher, can be lower. But yeah, many people pay more in taxes than they think. That's why we encourage people, hey, talk to your CPA beforehand, figure out exactly what your tax liability is. So we look at an example here, and this is not a real life example, just an example to give you guys numbers. On the left-hand side here, we're going to sell our investment property we've owned forever. We've owned it for 1 million years and fully depreciated. We bought it for next to nothing. Now it's worth $1 million. We're going to sell it and do it and not do a 1031 exchange. This whole 1031 thing is kind of confusing. So let's just cash out. We'll just say 25% in taxes. There's $250,000 out the door. It leaves us $750,000 to reinvest. And at a 75% LTV buys us $3 million in new property. That's great. I mean, we're buying new real estate, but we paid our taxes. On the right-hand side, if we do a 1031 exchange and we defer our taxes, we sell for $1 million. We get to reinvest that full $1 million in the exact same 75% LTV where we put 25% down. That $3 million turns into $4 million just because we did a 1031 exchange. The difference on $1 million of income is astronomical, especially over like 10, 20, 30 years. I mean, you might have $1 million of income just because you did a 1031 in this scenario, right? Not to mention in say 15 years, that $3 million purchase might be worth $6 million, and the $4 million purchase might be worth $8 million. Obviously, real estate fluctuates; it can go up, it can go down. But over time, you'd like to think that that $4 million property is going to do better than the $3 million property. Like-kind property, one of the most common questions I get. Kyle, I'm selling a rental. I don't want to have to buy another rental, but I know about this like-kind thing, and I think I have to buy another rental. Not necessarily. You can buy any type of property held for business or investment use. This could be retail, multifamily, 30-year ground leases. If you have a ground lease of 30 years or more, or options to extend past 30 years, that's treated as fee simple property. So we've had clients exchange into like a 30-year ground lease for a new Taco Bell, right? That's fee simple property, meaning that's exchangeable to the IRS. Commercial, industrial, timber rights in our state, water rights in our state, mineral rights anywhere, cell phone towers, air rights. I mean, you can really get off into the weeds with like kind. The majority of what we'll see is going to be commercial and rentals. But for example, if you have timber rights, for example, those would be exchangeable in our state. Eminent domain, I'm not going to get too far off in the weeds in this. Eminent domain is something that it's all self-reporting, but 1033 comes up a lot. This also works for condemned properties. But if you do a 1033, it's nothing that you would work with us, a qualified intermediary on. You'd work with your CPA and self-report. You'd have a longer time frame, but like kind means like kind when it comes to 1033. But for everything else, like kind is a pretty broad definition. The only thing I've run across that I can think of off the top of my head that doesn't work around here that you think might work would be houseboats. Houseboats are not exchangeable. Houseboats are personal property. It's the slip itself. That's what's taxed as real property. That's what's exchangeable. So if you have a houseboat, you cannot do a 1031 exchange on that houseboat. It's really no different than if you had an RV and set it down on a piece of land and tried to do an exchange. It's basically the same thing. Any questions on like kind? No?
Let me check the chat box here and see if there are any questions right now. I don't see any new questions.
Awesome.
Can I go back to the depreciation though? I know I'm going to get a question on that. Let's say you do not declare depreciation on your tax return, Kyle, and you were saying you're going to get charged depreciation anyway. Can you elaborate on that, please?
Yeah. So, a lot of people will say, oh, Kyle, you know, my wife and I never took depreciation because you had to pay it back. We pay it back regardless whether you take it or not. So whatever your depreciation schedule was or should have been, that's what you're going to be taxed on.
Well, there you go.
Yeah. Yeah. So
that's a really important point.
Yep. Yep. So everyone should be taking depreciation on their improved properties. But again, part of the importance of working with a CPA to make sure that everything's buttoned up on that transaction.
Yeah.
So what's not like kind? Basically everything else. Personal use properties is the big one. Primary residences, second homes, vacation homes don't qualify. Clients will say, "Oh, you know, I'm selling a rental down in Arizona. You know, I rent it out from April till October, and I want to do a 1031 on it. You know, I've been renting out for 20 years." I'm like, April to October, what happens from October to April? Is it just vacant? No. You know, my spouse and I are down there for the winter. That's not technically an investment property. If you're there for more than 14 days a year or 10% of the time you rent it out for, whichever is greater, it's not an investment property at that point for 1031 purposes. It's a personal use property. It wouldn't qualify. And so clients will say, that doesn't make any sense. I'm reporting rental income, this, that, and the other. That's just not how the rules and regulations stack up for that. So if you're using a property more than a couple weeks a year, even if you're running out, 6 months a year, it's not an investment property. So if you have a rental in like an Airbnb in Hawaii, some condo in Hawaii, and you're there for 10 days over Christmas every year, yeah, that's fine because you're only there for 10 days. It's less than a couple weeks. But assuming that you're there for 3 or 4 months, you're there all winter, that's not an investment property. New builds do not qualify. So Lennar, KB, Pulte, any of these home builders, they don't do 1031 exchanges. And flips don't qualify. So the trend here is that none of these things are held with long-term intent for business or investment use, which is what the IRS says. You need to hold for business or investment use. With flips, with long-term intent. With flips, there's no long-term intent. With new builds, there's no long-term intent, right? Because your goal is to get rid of those properties as quickly as possible. Like home builders, I mean, they want to sell a property even before it's built, right? Flippers, there's never any long-term intent there. So when flippers want to do 1031s, I tell them, hey, slow down, start reporting rental income, hold it for, at least a year or two. Talk to your CPA, see what they say. Because many CPAs would say if you are reporting rental or business income, it's not personal use, and you hold it for a year or more, you're probably okay. Elsewhere in the tax code, when the IRS says long-term, they mean 1 year or greater. More conservative CPAs might say hold for 2 years just to be safe and remove all doubt. We can't tell clients, oh yeah, you need to hold for X number of days because it's not defined. It's a gray area. So this is another thing where CPAs can provide valuable guidance. There's the same taxpayer requirement in 1031s. So the same taxpayer that sells also has to buy. If John Murphy sells, John Murphy has to buy. John Murphy can't sell and then buys a partnership with me because it's a different taxpayer, right? If Acme Incorporated, if Amazon sells, Amazon has to buy. Jeff Bezos can't buy. It's a different taxpayer altogether. So whoever the taxpayer is on title that sells, that's who has to buy the replacement property.
So Kyle, if you have a single member LLC, and this is what I ran into, so you own a property in an LLC, you buy another property, but the financing that you want to get on the other property will not allow you to finance the LLC. You have to close in your personal name. Does that qualify?
Yep, absolutely, because it would be the same taxpayer. And so we always have to be careful, like with spousal LLCs in community property states. Because there's sometimes, most often, two spouses, we'll say a husband and wife, for example, in a community property state like Washington or California, where they reside. If they have a spousal LLC, it's generally disregarded for tax purposes like a single member LLC. But sometimes we've seen that where the LLC is actually the taxpayer, not the individuals. And therefore, in that scenario, the LLC would also have to purchase. So as long as the LLC is disregarded for tax purposes, then yes, then you could buy as an individual or individuals.
Got it. Makes sense.
Yep. So vacation homes and conversions. This is really cool. So in 2008, the IRS gave us a very favorable safe harbor on how to convert your investment properties into your dream home. A safe harbor is basically a recipe where the IRS says, follow these rules and you're going to be okay. We're not going to come after you. So in 2008, they gave us a very favorable ruling for how to convert your investment properties into your dream home. So before 2008, it was a mess with people who would do exchanges and eventually move into their dream home, their primary residence. So in 2008, the IRS said, hey, if you do these things, you will be okay. This is okay by us. So let's say that you sell your investment properties in exchange into your dream home on the golf course in Arizona. The first 24 months that you own that dream home, you need to run it out for at least 14 days a year for each of the first 2 years. You also have to limit your own personal use to 14 days a year less for each of the first 2 years. That's it. After 2 years, you can move into it, do with it whatever you want. But the first 2 years, 24 months, needs to be an investment property. And it's key there, it is 24 months. Because we'll have clients in like October that say, oh yeah, this 2-year thing, that just means 2 separate tax returns, right? It does not, it means 24 months. And maybe you have an aggressive CPA and that's how they interpret it, but as the rule reads, as the safe harbor reads, it's 24 months, 2 12-month periods.
So before you leave that, Kyle,
yep.
You remember telling us a story at the REAPS meeting about the lady who had some problems with that? I don't know if it'll trigger your mind because I don't know the exact story, but it was
Cheryl Savage case.
It was kind of significant. Can you go over what happened there?
So there was this lady in California. She was actually a real estate broker and had her own, real estate firm, Cheryl Savage Real Estate or whatever it was. And Cheryl did an exchange into her dream home. I think it was overlooking the ocean. But she moved into it before the 2-year mark, before the 24-month mark. And the IRS, I think, audited her. They had some questions. They found out that she was actually living there before the end of the 2-year mark. She pled guilty, but she actually went to federal prison for 14 months because she moved in early. So I tell people, because they ask all the time, like, how is the IRS going to know if I'm, there more than 14 days a year, or I move in before the 24-month mark? I'm like, I tell them, hey, you need to follow the IRS guidelines. We've seen people go to federal prison who don't follow this rule. This rule is more than fair. I mean, the IRS could have said, we'll never let you move in. It's an investment property and will always be an investment property. This is actually more than fair for people like you and I. So we tell everyone, don't take the chance, follow the IRS rules and guidelines. They are more than fair. After you close on your sale, you have 45 days to identify a new property to purchase and 180 days to close. Ideally, you'll open up your exchange once you're under contract on the property you're selling, maybe a few weeks in advance, right? Then we'll set up the exchange. We'll work with the clients. We'll work with you. We'll work with title and escrow, make sure all the documents are in place. When that closes, that's day 0. From there, you have 45 days to identify a new property to purchase and 180 days to close. Does identification mean get under contract? No, but it's smart to do. There are 3 rules of identification, and you can only choose one of these 3 rules. The first rule, the most common rule, is the 3 property rule, meaning clients can identify up to 3 properties of any value to purchase. If that rule doesn't work, if you actually wanted to identify more than 3 properties, let's say that you're selling in the Seattle area and you want to buy 4 or 5 properties in Georgia, right? The 3 property rule wouldn't work because you're over 3 properties. So you go to the 200% rule. I mean, you could identify any number of properties totaling no more than 200% of what you sold for. So let's say that you sell for $900,000. Using this rule, you could identify any number of properties totaling up to $1.8 million. So that might be, 5 or 6 $250,000, $300,000 type properties. If those 2 rules don't work, if you want to buy a portfolio of properties and you're well over 3 properties and you're over 200%, you'd go to the last rule. It's called the 95% exception rule. I call it the all or none rule because you basically you can identify whatever you want. You could identify the entire, city of Kirkland if you want to. But the catch is that you'd have to close on basically everything, 95% of the value. Otherwise, your entire exchange would fail. So the one that most people will remember and use is the 3 property rule, but there's a rule that will work for no matter what the investor is doing. How do you identify? When clients close on their sale, we'll send them an ID form via DocuSign. It's got a few lines, a spot for them to sign and date. They put in the address, sign, date it, electronically submit it, get it back to us by 11:59 p.m. on the 45th day. The big thing is that it can't be ambiguous. You can't say, house near Green Lake. That doesn't work. It's got to be, 123 Green Lake Ave, Seattle, Washington. It's got to be a specific legal address or description. Mixed use exchanges here. Duplex. Let's say that I own that duplex and I live on the left side and rent out the right side. When I sell that duplex, The side I live in, I'm going to take the primary residence exclusion on the 250 or 500,000. And the side I rent out, the right side, I'm going to do a 1031 exchange on whatever that value is. So even though I live on a part of the property, it doesn't preclude me from doing a 1031 exchange. Monster-in-law unit. Yes, if you guys have a monster-in-law unit in back, an ADU, and your mother-in-law actually lives there and doesn't pay rent, well, that's not exchangeable. That's personal use. But if you rent to a college student, for example, and there's rent, then that's exchangeable. That's investment property. You know, it's an investment property for you. It's not personal use. Victorian. I didn't even know this was a big thing until recently, but let's say that you own a large 5-bedroom old Victorian in Northgate, and you live in 1 bedroom and rent out the other 4. Most of that property is going to end up being exchangeable because most of the property is held for business or investment use. Just because you live in part of the property doesn't mean you can't do a 1031 exchange on the business or investment portions. This is something that you would basically exchange whatever percentage of the property you were depreciating. So another thing that you'd want to make sure that your CPA is aware of and can guide on.
So Kyle, a clarification on that. So you own a Victorian and it's got 5 bedrooms and 4 baths and all of that, and you're living in one of the bedrooms and there's only 1 kitchen, but you rent out the other 4. You can still figure out what portion of the property been depreciation, and you can use that for 1031.
Yep, absolutely. It's nothing that we would be able to assist clients on figuring out, right? Because I don't. The CPA is going to have their own method because it's kind of a gray area.
All right.
So the CPA has to use your best guess. What's true investment property, you know, within this house? You know, 70%, 80%, whatever it is. That's what they would exchange. So there's, I don't think there's a science to it. It's up to a CPA's discretion.
All right, let's flip the coin to the other side. So you're selling that duplex and you live on one side and you do a 1031 on the other side. Can you buy another duplex and live on one side and do a 1031 for the other side?
Absolutely. Yep. Absolutely.
Well, that's pretty cool.
Yep. 100%. Okay. 1031s are unregulated. We want to make sure everyone understands that 1031s are basically the honor system, and a lot of money's been lost in the past with 1031s and qualified intermediaries. I get questions all the time from clients saying, how firm are you in the 45 days? Like, what if I find a property on day 50? We don't bend the rules for anyone. We've had large exchangers too, ask about that. We don't bend the rules for anyone. We play by the rules. We will make sure that your funds are there and all rules and guidelines are followed within the 1031. So you can always feel comfortable referring to us, knowing that we will help guide you to rules and regulations in the correct and fair way. And most importantly, that your money will be there. We have the highest level of security and protections in the industry. We're an ethical company and a well-capitalized company that again will make sure that your exchange is as successful as you want it to be. Sorry, my contact information is there, but I know John, we want to open up to questions and commentary too, if anyone has anything to say or add.
Yeah, let me look at the chat box again here and see if there's any questions in there, guys. I don't see any, but go ahead and type them in at this time if you would like, and I will see them. You can also raise your hand if you want to. Kyle, a couple questions I can ask that may be on people's minds here. Now, let me preface this a little bit. So I did a 1031 exchange mid last year. It's been something like that. And this timing thing, you don't want to push that. So what happened with us is we've identified a couple properties and we're moving forward. And then for whatever reason, I don't remember exactly what it was, they fell out of escrow. We didn't buy them. So we had like 11 days left in the 45-day period to identify other properties. We eventually did, but man, were we scrambling. So you want to start early in that 45-day process and make sure you identify those properties, because it wasn't, I think it was like Kyle was reaching out to me, you need to get these into us. And I think it was like the last couple of days we identified our properties. And then of course, everything went smoothly and they closed on time, but just word to the wise there. What other problems do people What's the typical thing they need to be aware of, Kyle, and avoid when they're doing a 1031, besides maybe that timing thing?
Well, so yeah, I mean, the two basic rules: buy for equal or greater value and reinvest your proceeds. A lot of people are under the assumption, hey, when I originally bought this property 10 years ago, I put 250,000 of my own money down. I should be able to get that back. You can't get that back. If you take that out, it will be taxable. And they don't understand that because it doesn't make sense to them. They say, hey, that's my money. It's not the IRS's money. Well, the IRS doesn't look at it as your down payment. They look at that as depreciation, recapture, capital gains, money that should be taxed. So whether you think it's fair or not, that's just how the rules are. So if you want to pull out your original investment, you can do that. It would just be taxable. So buy for equal or greater value, reinvest your proceeds. And yeah, the other thing is what you alluded to, identification. As soon as you're under contract on your sale, start looking for new property. If you can get a longer closing, maybe you get instead of a 30-day close, maybe you get 60 days or sooner. If you need to close in 27 days, you can. But if you need 60 days because you're not finding anything or inventory's low, get a longer contract like that, a longer closing on your sale.
Absolutely. I'm not sure if it's really clear here, Kyle, what happens with the money and how it actually flows when you close on your property and then you get $200,000 to $300,000 that you're going to reinvest. Can you describe that process, please?
Yeah. So when you normally close on a sale, assuming that everyone's closed on a personal residence or something, when you sell your property, escrow wires money to your bank account after closing. In the 1031, we'll assign in, so they wire funds to us to a bank account we hold on the client's behalf. So we will open up segregated commercial bank accounts, large banks. We don't use regional banks, small community banks, for example. We use large, well-capitalized banks to hold funds. Clients collect interest, granted it's not much. But once clients identify and they're ready to close, we can send out earnest money and we can send out the down payment to escrow for their purchase.
Absolutely. He did this last time. So any interesting stories? That lady that you talked about earlier, that was really impactful, I think, to our group when we heard about her. You don't want to mess with that. Any other interesting stories? Any troubles that people have had that we can learn from, Kyle, that you might want to share with us?
So, yeah. So one thing that clients need to understand is that, there's, it's unregulated, but there's a few Treasury regulations that we have to follow within Section Code 1031. One of them is when we can give money back to clients. So clients, one, they can't use this as a bank. So they can't say on day 36, hey, send me $50,000, I'm going to buy a new car. It doesn't work like that. We can only fund earnest money in their down payment. And theoretically, agreed upon inspections, a couple other things, but basically earnest money in their down payment. And they cannot get money back before day 45, before their ID period closes. The earliest they can get it back is day 46. And if they do identify properties, we can't refund the balance for 180 days. We actually make clients sign a disclosure. John, you sign this in big red letters that says, when can I get my money back? So we want to make sure going in that clients understand when they can get their money back. If they identify a property on, let's say they identify 123 Main Street, Seattle, Washington on day 42. And on day 47, it sells to someone else. We can't refund their balance legally until the 180-day exchange period is over.
Oh, there you go.
So yeah, I've got numerous stories where, clients don't remember signing this and that, and the other, or want to use this as a bank. They cannot do that. So yeah, we make clients sign a very clear disclosure on when they can get their money back.
Okay. And then one thing we haven't covered here, reverse exchanges. Kyle, can you describe those, what they're about and how people might want to use them?
Sure. Yeah. So reverse exchange is where a client closes on a purchase first and then their sale. In the reverse exchange, we actually have to take title to that new property. We require a lot of liability insurance. We'll file an LLC with the state to hold title to that property. Many times we need like a clean phase 1 environmental report. There's a lot that can go into it. A normal exchange is less than $1,000. A reverse exchange would start at like 6,000 or so. So it's a lot more complicated. It's a lot more expensive. Clients can't get a conforming loan on it either. So that rental that you want to buy in Burien for $625,000, you're not going to get a conforming loan for that if we have to take title to it. You'd need to have cash or hard money to do it, which is super expensive. So many times it doesn't even make sense. It doesn't pencil out once you look at, bridge cost of a bridge loan and, our fee, and, sometimes there's additional title and escrow fees because we take title and the clients take title from us. So it can just be complicated and expensive. But if you need to do a reverse exchange, there's probably a way to do it.
All right, good to know.
Yeah.
One of my clients asked me this question, I'm remembering now, Kyle. They purchased a property in a 1031 exchange and they owned it less than a year. I think they own it right now less than 1 year. And they want to sell it to buy another property in a 1031 exchange. So if they sell it less than 1 year and they do a 1031 for something else, is that going to be disallowed?
I mean, there's not rules on holding period. It's just the IRS has said you need to hold with long-term intent for business or investment use. I mean, there's extenuating circumstances. We've seen people where, they buy a property in February for $600,000, and then, in October they're getting an offer from a developer who's buying up the block for $825,000. It's like, I kind of have to take this, right? We'll talk to your CPA, and the CPA is like, absolutely. You had tenants in there. You had no intention of selling this. 9 or 10 months later, you basically got an offer you couldn't refuse. So it's a case by case basis, but under a year, we definitely encourage, talk to your CPA, make sure they're comfortable with what your long-term intent was. But if there's long-term intent there, then they can prove what their long-term intent was. They can definitely, move forward with that. But again, big caveat, talk to a CPA.
Yeah. Okay. That's a good answer there. I'm looking at the questions here, Kyle. I think you did good. I don't have any questions in the chat box. Guys, this is going to be on our YouTube channel as well. You'll see Kyle's information there. If you need to contact him directly, he's okay with that. If you have any questions about 1031 exchanges, any specific thing for you, feel free to give him a call. His email address is there. My information will be on the screen as well. Give me a call if you have any questions on the mortgage side of things. Kyle, thanks again for your time. Appreciate it.
Yeah, thanks everyone. Have a good day.
Good to see you again.